Hello, and welcome to Chapter 8 of Management 3350, Small Business Management, where today we will talk about the organizational plan and organizational structure of businesses and what entrepreneurs need to consider before they open their business on exactly how they are going to manage their business. Here are the learning goals that I will let you review quickly. So, when an entrepreneur is thinking about opening a business, one of the things that he or she needs to consider is how is the business going to be managed? In other words, who's going to manage the business on a day-to-day basis? Now, in most small businesses that start out as one-person operations, much like the businesses that I have started, it's just yourself. But as time goes on and the business grows, there has to be a plan in place as to exactly who's going to take what responsibilities. Because after all, if the business is going to be successful and grow, you're going to have to hire people to help you run that business. Some of the characteristics of a strong management team are people who would be capable of securing resources for you. In other words, maybe they might invest in the business, or they may actually know people who might want to help the business grow by adding capital to the firm as a silent partner or whatever the case may be. If we're looking at investors to help us start the business, more than one person is reassuring to investors. In other words, if there are 2 or 3 capable managers already in the firm, that helps reassure investors that that their investment is safe and that the business is going to thrive. But primarily for a small business, to me, the biggest element of a strong management team is the diversity of talent. In other words, what do the managers bring to the table? Where one manager might be really good at the numbers side, another manager might be really good at sales. Someone might be really good at production or engineering. Some person might be really good at securing capital from investors. So that diversity of talent to me is one of the strongest things about the characteristics of a management team. And before I move to the next slide, so what is a management team? Basically, they're the key people that keep the business running and give the organization or the business its general direction. They know what the business is about. They know what the primary goal and purpose of the business is, and they keep it going successfully and keep it running in that to that goal. When an entrepreneur is trying to design a management team, you're looking at trying to define the relationships between the managers. What can they do, and what will they do? You can actually go outside the firm through consultants to help you with this. That can give the management team some ideas and some direction. Or you can appoint a board of directors or an advisory council, which we'll talk about at the end of this chapter. So let's get into the meat of the chapter, which is the business structure. How are we going to structure this business? Now, I'll tell you right now that the majority of small businesses start out as sole proprietorships. And in other words, that's one business owner that bears the unlimited liability for the business. And most businesses start this way. And in fact, throughout their lifespan, most businesses end up just being sole proprietorships. One owner. So what are some advantages of being a one-person operation? Well, first of all, that owner gets all the money. They receive all the firm's profits. They don't have to split the profits between partners because there are no partners. They don't have to split profits between shareholders or other investors because there are none. They hold title to all the assets of the business. So when I opened up my medical equipment company, I was the sole owner of all the inventory, all the supplies, all of the shelving, computers, sales, point of sale systems, software, company van, delivery van. I was the owner of it all. I held the title. I didn't have to split that or share that with anyone. Another advantage is if I wanted to, I could transfer the ownership of the company quite quickly, which I did after a few years in business. When I sold the business, it was a very easy transaction just to simply transfer the ownership to another company or another group of individuals. Most sole proprietorships require no registration or filing fee, and they have no one to really answer to. They have absolute freedom from interference from other owners, investors, or stakeholders. So they have complete control of the organization. So what are some of the disadvantages? I mean, there's a lot of advantages to be a sole proprietor, but obviously there's some disadvantages as well. Well, first of all, they bear all the risk. When I opened my business, I was the only person risking anything. I was risking capital, money that I had saved and put into the business. If the business would have been sued, I bore the risk of that. So there's the business risk that the owner bears. They're subject to all the claims of creditors. In other words, if I charged something or I bought something from a vendor, I was responsible for paying that. They have unlimited personal liability for the business. Now, I'll talk about ways to sort of counter that liability through a limited liability company later on in the chapter. Receives no tax-free benefits as an employee. The death of the owner terminates the business unless there's someone that will inherit the business. The capital that's raised is limited to the sole proprietor or the entrepreneur's personal capital. In other words, if I open a business, I have no investors, I have no partners, the only source of capital that I have is my own. So that's a disadvantage because some people want to open a business but don't have a lot of capital. Fortunately for me, I was blessed to have my house paid off. I took an equity line of credit out on my home, which gave me more than enough money to open the business. And we'll talk about that strategy in another chapter. The personal income is taxed. The business income is taxed as personal income. So the money that you make in the business simply goes on your regular personal income tax form as your income. That's how it is reported to the IRS, and that's how it is taxed. When we take a look at different forms of small businesses, we primarily are going to focus on the sole proprietorship, the partnership, and the corporation. And again, the sole proprietorship being the most common, by far and away, the most common form of business structure in small businesses. We'll also talk about partnerships and corporations. But here you can see the different types. In a sole proprietorship, that's basically what it is. In a partnership, you have general partners and limited partners. You don't have to have both, but you always have to have a general partner, which I'll discuss in a minute. And corporations, where corporations you have C corporations, S corporations, limited liability companies, professional corporations, and nonprofit corporations. And I'll hit on all of those. As I mentioned earlier, if you took a look at all the businesses in the U.S., sole proprietorships make up more than 60% of all businesses. So this is small businesses right here. And then most of these partnerships are small businesses. There's some C corporations that are small, but not many. And the S corporation, which we will talk about as well. But you can see where sole proprietorships are by far and away the most common. So what is a partnership? Well, a partnership is when two or more people get together to open a business. You may have a friend who you have, both of you have been thinking about this idea and you want to open a business and go into business and you decide to do it together. It's a partnership. Do they have to be equal partnerships? No. But most partnerships are probably equal partnerships, and it just depends. And it can be more than just two people. It can be 3, 4, 5, 10 people can join into a partnership. The qualifications simply are you have to be of legal age to contract, and obviously the desired qualification is honesty and capable and compatible with all the partners. Why do we say honest? Well, when you have more than one person working in the business, it's hard to keep track of who might be stealing from the business or skimming off the profits or whatever. So honesty is definitely one of the things that partners are looking for, a good, honest partner. And sometimes that's not easy to find, believe it or not. So some questions about partnership. One of the things that you have to ask yourself is, what is the business and why do I need a partner? The example I give all the time is I think a really good one. And let's say you wanted to open up a franchise restaurant and you were a really keen business person, but you had no idea about how to run a restaurant. Well, you may find people who would be really good partners. Maybe you find someone who's got a lot of experience running a restaurant. Maybe you find someone who's really experienced in kitchen management or bar management. And these people, based on that business concept, these people can really help you. And then you might ask, how are we going to structure ownership? Well, if everyone invest equally in the business, it's probably going to be a fairly equal ownership. So let's say you had the idea, you were the business person putting up $50,000, and then you found a kitchen manager, a bar manager, and a restaurant manager, and they were all going to put up maybe $50,000. Well, probably the ownership is going to be split 25, 25, 25, 25%. Why do we need each other? So as you're forming this partnership, thinking, why are we coming together to open this business? Obviously, in this example, we need someone to run the business. We need someone to take care of the kitchen. We need someone to take care of the bar. We need someone to take care of manage the restaurant inside the restaurant or the dining area. So everyone pretty much is going to be contributing equally. How do our lifestyles differ? You might ask, well, why would that even matter? Well, let's say out of those 4 individuals that are forming this partnership for this restaurant, let's say one of them loves to travel and loves to golf. And after opening the business, you find out that they are never at the restaurant. They are always out golfing or they are always traveling. That's going to create conflict. So we need to know the lifestyles of these partners. What are the main responsibilities of each partner? And that's defined early on before the partnership is made. Choose your partners carefully, obviously. Be open but cautious about partnerships with friends. Many a partnership has ended a friendship, that's for sure. And make sure that you have a combined vision for the business, that everyone has the same goal and understands the goal of the business. Some rights and duties of partners. The partnership agreement, obviously, that spells out explicitly the rights and duties of everyone involved, who's responsible for what, keeping in mind that there is joint and several liability. And what that means is if you have, let's say you're in a business and you have two other partners, let's say there's three partners. Any one of those partners can go out and make a decision or sign a contract for the business. That contract is all three partners are liable for that contract. So it legally binds all the other partners. So this is something to keep in mind, and that you may want to put into the partnership agreement, that if any contracts are signed, all three partners have to have, the contract has to have all three signatures. Termination of a partnership. Let's say one of the partners doesn't want to be a partner anymore or passes away unexpectedly. What happens to their shares of the business? What happens? Does their family get it? Do the other partners have the first refusal right to purchase that partnership amount from the family? So how's that going to work out? So there are advantages to partnerships. They're easy to establish, and the skills, the diversity of skills, as I said before, is very important. So if in the restaurant example, the complementary skills are very valuable. Division of profits are equal. That can be an advantage or a disadvantage. Larger pool of capital to work from. So if you've got four people that are the owners of this business, you've got four pockets to pull from. Those people may know other people that might be willing to invest in the business. Ability to attract limited partners. Minimal government regulation. It's pretty much governed like a sole proprietorship. There's flexibility to the market. Taxation is single taxation or personal taxation, much like the sole proprietorship. Disadvantages: unlimited liability of at least one partner. So I had mentioned earlier about general and limited partners. Every partnership must have at least one general partner. That means that if there are four partners, all four partners can be general partners, which means they all share in the liability equally. However, you might have four general partners and four limited partners. The limited partners are only liable for the amount that they invest. Okay, so if, let's say, this restaurant takes off and one of the owners come to me and they say, "Hey Jim, this is a really good deal. We're doing really well, but we need to expand. We need $25,000. Would you be interested in being a limited partner?" And I'm thinking, well, I can invest $25,000 there in that business and maybe make a return of 10% a year, which is certainly more than I'm going to make it at the bank and maybe in the stock market. So I'll invest $25,000 and say, yeah, I'll be a limited partner. Here's $25,000. If that business or that restaurant gets sued and money has to be given to for the lawsuit claim, the only money that I have at stake is the $25,000. The owners have everything. They have personal liability, the general partners. So every partnership has to have at least one general partner. If you have an equal partnership of two people, usually they're both general partners. There's always potential for personality and authority conflicts. Partners are bound by the law of agency. Everyone's bound and has liability to some extent, but there's unlimited liability for at least one partner, and that is the general partner. Then we have the corporation option, which is where a business gets large enough that they want to organize and operate as a legal entity. And this will enable the owners to provide themselves limited liability, because a corporation is looked at as, from the government and from law, as an artificial person. It can be sued and hold property rights, incur debt. So, for example, Ford Motor Company, when they get sued, the investors or stockholders of Ford Motor Company, they're liable from an extent that the price of their stock might go down if it was a large lawsuit, but they don't have to pay the lawsuit personally. And so it's the entity itself that's being sued. You're going to see the C corporation in small businesses that become much larger. And they have to sell stock, and it's very expensive. Let's see if we go into... the one last thing about the C corporation, it's a regular corporation that's chartered by the state. So it's taxed by the federal government as a legal entity. Also, the dividends that are paid out are taxed. So there's such a thing, and you've probably heard this term, double taxation. That's a huge disadvantage for a corporation. Here's one of the holdbacks, or the things that hold companies back from incorporating. You have to provide a lot of information, and it's expensive. You have to hire lawyers to get this together, and incorporating is not something that happens immediately. It takes time to incorporate, takes a lot of effort, and it is expensive. And you can see of all the things that you have to put together for a corporate charter. The articles of incorporation include the name of the company, the type of business, the name of the incorporators and directors, capital stockholders, and so forth. So there's a lot that goes into a corporation. So the C corporation is basically common amongst large businesses. Now, in a corporation, you have stockholders that receive a stock certificate that gives them a share of the company. And a preemptive right is simply the right of a current shareholder to buy new shares of stock as they're issued before they're offered to the public. But most large corporations are going to have stockholders. Again, legal status. It's an entity of itself, and ownership can be transferred without affecting the firm's operations. So Ford Motor Company, millions of shares of Ford Motor Company are transacted every day. It doesn't affect the operations of the business at all. It just continues to flow. So if you take a look at some comparison here, these next two slides just compare the sole proprietorship, partnerships, and C corporations. And you can see the differences between them. You can take a look at that at your leisure. So as an entrepreneur, when we're trying to form this organization, what are some of the things that we're thinking about, or what are the factors that affect our choices? Well, obviously, the cost. Most small business owners don't have a lot of money to create a corporation. So that's probably not going to happen in most cases. The liability of the owners. How much liability do they want to have? And most entrepreneurs are willing to provide unlimited liability, at least at the beginning of their business, because it's fairly small. Income tax. How do they want to be taxed on the business? Attraction of capital. If you need a lot of capital and you can't provide it yourself, you're probably going to have to look into some sort of partnership or some type of corporation, which I'll talk later about how small businesses can incorporate without all the hoops to jump through that larger corporations have. How much control do you want to have, or how much control of management do you want to give up? So if you don't want to give up any control and you want to call all the shots, then you're probably going to be a sole proprietor. If you're willing to give up some control, then you might look into a partnership or incorporating. How do you want the transfer of ownership to occur? I mean, do you want to start this business, run it for a while, get it up and running, have it successful, and then sell it? Then you probably want to be a sole proprietor, because it's very easy to do that. When I started my business, one of the things I had in the back of my mind from the very beginning was, if this business flourishes and is successful, I may want to sell it and make a profit from it. So I knew that I could do that quite easily, and did that quite easily as a sole proprietor. Continuity of the business. Remember, this sole proprietorship, if the owner passes away or wants out, the business ceases to exist unless they sell it. So all of these things are factors that an entrepreneur would think about as they move forward and decide what type of structure to create. And we've talked about this a little bit, but sole proprietors are taxed. It's taxed as personal income. Partnerships are taxed as personal income as well, but it all depends on how much is divided by the partners. If, let's say, that restaurant that we were talking about where there were 4 partners, 4 equal partners, and let's say that the net income at the end of the year was $100,000, well, then all 4 partners are going to have income of $25,000, and it's going to be taxed as personal income. Corporations are a little bit different. The corporation itself, the legal entity, is taxed. The owners are taxed through the dividends. So the dividends that are declared for the stockholders, that's being taxed. And that's where you get double taxation, because not only are the dividends being taxed, but the business itself, the income from that the business realizes, is being taxed. So it's being taxed twice, which reduces the dividends. Limited partners, I've sort of talked a little bit about that. So if we, quickly as I go through these specialized forms of organizations, just remember there has to be a general partner. There can be limited partners, but they're only liable for the investment that they make into the business. Where someone has to have personal liability for the debts of the business. Corporations, small businesses that want to incorporate would not incorporate as a C corporation most of the time. Most of the time they would incorporate as an S or subchapter corporation. So an S corporation is where a small business incorporates to get rid of some of that personal liability. Some of the requirements are no more than 100 stockholders. So it's a very tightly held company. Sometimes there'll only be maybe family and friends that own stock of the company. All stockholders must be individuals, estates, or trust. Only one class of stock can be outstanding. It operates on a fiscal calendar year. And so an S corporation is, if a small business owner or owners wanted to incorporate, they're probably going to incorporate as an S corporation. This allows the owners to shed themselves of the unlimited liability. So they actually have liability limited to the investment of the company. Now the company will have to have liability insurance, the entity itself. One of the benefits that the government, it does allow the S corporation, is there is no double taxation. Okay, the income passes taxable income to the holders, but it's just personal income. There's no double taxation or dividends. A lot of small business owners, especially sole proprietors, can form an LLC. An LLC is a limited liability company. A lot of times it's labeled as a limited liability corporation. But a limited liability company is very easy to set up. And in the state of West Virginia, I believe it only costs $50 to set it up, and then $25 a year to file an annual fee to keep it going, to keep it existing. And it limits the liability somewhat for the owners. So if you were going to create a lawn care business where you maybe bought a truck and several lawnmowers and you had maybe 50 yards to maintain every summer, it would be in your best interest to form an LLC, because an LLC will protect you from some lawsuits and protect you to some amount. So if you're interested in starting a business, you can always ask me about it. But the Secretary of State's office has a very nice website that you can find. It's very simple and very inexpensive to set up. The professional corporation is more like doctors and lawyers and accountants. That you'll see that where a PLLC after the name of a lawyer or an accountant, and again that protects their personal property from any type of lawsuit. And then we have nonprofit corporations, which are corporations that exist that are charitable or civic or educational. They have those goals that profit is not the main goal. So there's, the United Way supports a lot of nonprofit organizations out there, and people can create nonprofits if they're interested. But again, it has to meet certain guidelines. Strategic alliances are simply informal partnerships between companies that help each other. And so maybe a restaurant might form a strategic alliance with a company that supplies food. And that's probably not a really good example. A strategic, let's put it this way. Let's say you want to cook food, but you don't want to serve food or deliver food. A strategic alliance might be between someone who creates dishes or meals and then hires another firm to go out and market those meals or deliver those meals. Again, that's not a great example, but you get the gist of it. You're sharing resources. And probably the best example is from my days in pharmaceuticals, when a pharmaceutical company would create a drug, but they didn't have a presence in a certain area. So let's say that Johnson & Johnson Pharmaceuticals created a new drug for the coronavirus, but they did not have the manufacturing ability in Africa. So they may create a strategic alliance in Africa with a pharmaceutical company that will help them manufacture the vaccine for the coronavirus, and they will distribute that. They'll license that firm in Africa to actually distribute the vaccine. And so that's a pretty good example of a strategic alliance. And here are some popular types of strategic alliances. Licensing, where you let someone sell your product because you don't have a presence in that area. Distribution, marketing, production. You can see there's lots of ways to create a strategic alliance in order to get your business up and running. Maybe you have this idea of some gizmo, but you don't have the ability to produce it, and you create a strategic alliance with a factory who can actually produce the item. Getting towards the end here, but I do want to mention the board of directors. Corporations have board of directors. They're required to. And these directors can be from inside or outside the firm. Well, there's always a mix of people from inside and outside the firm. And they help guide the company or the corporation, and they actually review top management's performance. They'll declare dividends. They'll help create strategy and approve strategy that's been created by top management. And again, they provide general direction. They monitor the firm's ethical behavior. And actually, the CEO reports to the board of directors. That's who the CEO answers to. And whenever a CEO is fired, it's the board of directors that makes that decision. However, on a smaller scale, for a small business, you would want to create what we call an advisory council. And an advisory council would just help offer advice to the owners. Obviously, they would not report to the owners would not report to the advisory council because it's a small business. They own the business. They only report to themselves. But an advisory council can really help provide any type of advice that the company might or the business might need. So let me give you an example before we end it here. My business was a medical equipment company. My business or my advisory council was made up of 2 physicians that I was friends with, a rehab specialist in a rehab hospital, my accountant, my best friend, who was also my insurance agent. So you can see where these people could offer sound advice to my type of business, whether it was from the financial side, the accountant and the insurance agent, or if it was from the product side, medical, the doctors and nurses and rehab specialists. So it's really wise to create an advisory council that can help you. Most often these people are friends of yours or people that you deal with, and they're not paid, but they offer advice and guidance because perhaps you pay for their services in other ways, such as a lawyer or an accountant or buying insurance. And here are the key terms for the chapter. So I hope you got something from the chapter. You will proceed to chapter 9. There is no assignment for chapter 8. And then after chapter 9, you will take a quiz on chapter 7, 8, and 9. If you have any questions, please let me know. Have a great day. Stay safe. Stay healthy.